What's up, Electro Drive News fam? Get ready to buckle up because the automotive world is absolutely buzzing, and we've got the hottest, fastest updates hitting you right here, right now. The pace of change is insane, and if you blink, you might just miss the next big thing. We're talking about market shifts, brand comebacks, and strategies that are redefining the road ahead. You don't want to be left in the dust, so stay locked in for the intel that matters. Let's dive into the action. First up, the battle for dominance in China's electric vehicle sector is heating up like never before. We've got the latest August sales figures from the major players, and one company is making a serious comeback, another is pushing forward with steady gains, and a third is hitting a surprising roadblock. Who's leading the pack, who's surging ahead, and who needs to recalibrate? We've got the numbers that tell the story. Then, we're shifting gears to the financial markets where some big names are making waves. Stock futures are showing some serious movement, and we're zeroing in on the companies that everyone is talking about, from electric vehicle giants to the folks behind those massive data centers that power our digital lives. What's driving these market shifts, and where are investors placing their bets? Next, we're getting the inside scoop straight from the source with a deep dive into a major electric vehicle manufacturer's recent earnings call. They're talking growth, they're talking strategy, and they're addressing the challenges head-on. We'll break down what this means for their future and for the industry as a whole. And finally, we're uncovering some fascinating contradictions and strategic plays from another leading EV company's latest financial report. Are they hitting their targets? What's the real story behind their R&D cost control, break-even strategy, pricing, and vehicle margin targets? We've got the analysis you need to understand the full picture. Stick around, hit that subscribe button, ring that notification bell, and let's get into it. China's EV race heats up. NIO's August comeback, XPeng's steady rise, and Li Auto's August slowdown. The competition in China's electric vehicle market is fiercer than ever, with August sales data revealing a dynamic shift among the leading manufacturers. NIO has staged a remarkable comeback, driven by its latest model, while XPeng continues its impressive growth trajectory. However, Li Auto is facing a period of adjustment, signaling a complex and evolving landscape for these automotive innovators. NIO has demonstrated a significant turnaround in its August deliveries, reaching a new historical high of 31,305 units. This surge is largely attributed to the strong performance of its new L90 model, which launched on July 31st and began deliveries on August 1st. The L90 alone delivered 10,575 units in its first month, becoming the fastest model in NIO's history to surpass 10,000 deliveries. The company's overall August figures were bolstered by deliveries of 10,525 units of the E8, 16,434 units of the E6, and 4,346 units of the ET5. This impressive performance allowed NIO to surpass Li Auto in monthly deliveries for the first time in 33 months, and contributed to a strong August for its stock, which saw a cumulative increase of over 31%. Qin Liheng, co-founder and president of NIO, highlighted the L90 as the brand's current short-term focus, expecting its strong sales momentum to continue. Looking ahead, NIO has provided a third-quarter delivery guidance of 87,000 to 91,000 units, a year-on-year growth of 40.7% to 47.1%, and anticipates record revenue, indicating continued optimism. XPeng Motors also reported exceptional August results, with total deliveries reaching 37,709 units, a staggering 168.7% year-on-year increase. This marks the 10th consecutive month that XPeng has exceeded 30,000 deliveries, setting a new monthly record for the company. The Mona M03, a compact pure electric sedan, was a key driver, delivering over 15,000 units in August and maintaining its streak of over 10,000 monthly deliveries for 11 consecutive months, establishing a strong foothold in the sub-150,000 RMB intelligent driving market. The XPeng G6, a midsize pure electric SUV featuring advanced driver assistance systems, also saw an 11% month-on-month increase in August deliveries and is reportedly leading sales in its segment in Europe and the Middle East. XPeng's CEO, XPeng, indicated that the company expects to maintain monthly deliveries above 40,000 units starting in September, reinforcing its aggressive growth strategy with a third-quarter delivery forecast of 113,000 to 118,000 units. In contrast, Li Auto experienced a challenging August, with deliveries declining for the third consecutive month. The company delivered 28,529 new vehicles, representing a year-on-year decrease of over 40% and a 7.2% month-on-month drop. This downturn has led to a significant decline in Li Auto's stock price. While the Mega Series delivered over 3,000 units, and production capacity is expected to increase, the overall performance of the Li Series appears to be at a yearly low. Market analyses suggest that Li Auto's reliance on extended-range electric vehicles, increased competition from NIO's price adjustments, and a perceived dilution of its family-oriented positioning are contributing factors. The company is accelerating production of the Li L7 and plans to launch the Li L6 in September, aiming for monthly deliveries of 9,000 to 10,000 units for that model. However, its third-quarter delivery forecast remains cautious, projecting 90,000 to 95,000 units, a potential year-on-year decline of up to 41.1%. Beyond these three, Leapmotor also achieved a record high of 57,066 vehicles delivered in August, an 88.31% year-on-year increase, while Xiaomi Automotive continued its upward trend, surpassing 30,000 deliveries for the second consecutive month and reaching second place in sales rankings. The market anticipates continued growth through the Golden September and Silver October period, supported by government incentives and trade-in programs. This sales data highlights a clear divergence in performance among China's leading EV manufacturers, indicating a highly competitive environment where product innovation and strategic pricing are paramount for sustained success. But what does this sales surge mean for the broader market sentiment? And what's happening in the world of stock futures that has investors on edge? Stock futures dip as key sectors face scrutiny. NIO, jewelers, and data giants in focus. Global stock futures are signaling a cautious start to the trading session, with several prominent companies and sectors drawing investor attention. Market sentiment appears to be influenced by a mix of corporate performance, economic indicators, and sector-specific challenges, leading to notable movements in futures contracts for major players. Investors are closely monitoring companies like NIO, the electric vehicle manufacturer that has recently shown signs of recovery in its sales figures. Despite this internal progress, the broader market sentiment and sector-specific news can significantly impact its stock performance. Any updates regarding NIO's production, delivery targets, or financial health are likely to be scrutinized by traders and analysts alike, especially in the context of an increasingly competitive EV market. The recent volatility in EV stocks, influenced by global economic conditions and regulatory changes, means that even positive company-specific news can be overshadowed by wider market trends. As such, NIO's inclusion in the list of stocks to watch suggests that its performance is being viewed as a barometer for the health of the EV sector and its ability to navigate market headwinds. Signet Jewelers, a prominent name in the retail jewelry industry, is also in the spotlight. The performance of retail companies is often closely tied to consumer spending, which can be sensitive to economic fluctuations. Signet's inclusion in this watch list indicates that its financial results or forward-looking statements might be signaling broader trends in consumer behavior or the retail landscape. Factors such as inflation, interest rates, and consumer confidence can significantly impact discretionary spending on items like jewelry, making Signet's performance a key indicator for the health of the retail sector. Furthermore, stocks associated with hyperscale data centers are attracting significant attention. These companies are integral to the digital infrastructure that supports cloud computing, artificial intelligence, and the vast amounts of data generated daily. The demand for data storage, processing power, and connectivity continues to grow exponentially, positioning these companies for sustained expansion. However, the sector is also capital-intensive and can be affected by technological advancements, competition, and the cost of infrastructure development. Investors are keen to understand how these hyperscale data providers are managing their growth, investing in new technologies, and maintaining their competitive edge in a rapidly evolving digital economy. Their performance is crucial for understanding the trajectory of the digital transformation and the companies that are enabling it. The overall dip in stock futures suggests a prevailing sense of caution among market participants. This could be due to various factors, including upcoming economic data releases, geopolitical events, or concerns about corporate earnings. The specific mention of NIO, Signet Jewelers, and hyperscale data stocks implies that these companies, representing diverse sectors, automotive, retail, and technology infrastructure, are at the forefront of current market discussions. Their individual performances and the collective market sentiment surrounding them will be critical in shaping the trading day ahead and potentially influencing broader market trends. These market movements set the stage for understanding the financial health of key players. But how are these companies performing operationally? Let's look at NIO's latest earnings call for the inside story. NIO Inc.'s Q2 earnings call, navigating growth with strategic focus and operational hurdles. NIO Inc. recently concluded its second quarter earnings call, presenting a narrative of robust growth in vehicle deliveries and strategic advancements, balanced by acknowledgments of prevailing industry challenges. The company highlighted significant year-over-year increases in deliveries and revenue, underscored by successful new product launches and an expanding service infrastructure. However, the call also addressed critical areas requiring attention, such as reduced vehicle margins and ongoing supply chain constraints. In terms of deliveries, NIO reported a substantial figure of 72,056 smart EVs delivered in the second quarter, marking a notable 25.6% increase compared to the previous year. The momentum carried into July and August, with deliveries reaching 21,017 and 31,305 units, respectively. Building on this strong performance, NIO has projected third-quarter deliveries to be within the range of 87,000 to 91,000 vehicles, indicating a significant year-over-year growth of 40.7% to 47.1%. This optimistic outlook reflects strong market demand and the company's expanding production capabilities. Financially, NIO showcased improved performance with a non-GAAP operating loss that narrowed by over 30% from the previous quarter. Vehicle sales experienced a significant surge of 62.3% quarter-over-quarter, attributed to effective cost management and strategic revenue growth initiatives. The successful launches of the Envoy L90 and the redesigned Ease 8 have reportedly been met with strong market reception, bolstering user confidence and reinforcing NIO's position as an innovator in the electric vehicle space. NIO's commitment to its customer base is evident in its extensive infrastructure development. The company operates 3,542 power swap stations globally, having facilitated over 84 million battery swaps. This expansive network, particularly along major Chinese highways, is a key differentiator and supports the company's growth and customer satisfaction strategies. Furthermore, NIO's models, including the Firefly, have received high safety ratings and ranked prominently in J.D. Power's NEV quality studies, indicating positive user feedback and market validation of the brand's quality and reliability. Despite these positive indicators, NIO acknowledged a dip in vehicle margin to 10.3% from 12.2% year-over-year, primarily attributed to a shift in product mix. This reduction in margin presents a key challenge that the company aims to address. Additionally, production capacity for new models, such as the Ease 8 and L90, is currently facing constraints, which could impact overall sales potential and lead to delivery delays. Managing these supply chain challenges is identified as crucial for sustaining the company's growth trajectory. Looking forward, NIO has outlined ambitious targets, including a fourth-quarter vehicle gross margin of 16% to 17%, and achieving breakeven on a non-GAAP basis. The company also aims for a quarterly delivery target of 150,000 units and long-term gross margin targets of 20% for its new brand and at least 15% for its Anvo brand. R&D expenses are projected to remain stable at RMB 2 billion per quarter, with SG&A expenses kept within 10% of sales revenue. In summary, NIO's Q2 earnings call presented a comprehensive view of a company actively pursuing growth through product innovation and market expansion, while proactively managing financial performance and operational efficiencies. The key challenges of vehicle margins and supply chain constraints are central to its near-term strategy, with clear targets set for future improvement. While NIO is charting a course for growth, other industry players are facing different market dynamics. Let's now turn our attention to the strategic decisions and potential contradictions emerging from another major EV manufacturer's latest financial disclosures. NIO's Q2 2025 financials. A closer look at R&D, break-even, and margin targets. NIO's second quarter 2025 financial report reveals a complex picture of strategic execution, particularly concerning research and development costs, the pathway to profitability, pricing strategies, and vehicle margin targets. While the company is pushing forward with ambitious growth plans, the details within the report suggest areas where strategic alignment and market positioning are under intense scrutiny. The report indicates a significant outlay in research and development, a critical investment for any technology-forward automotive company like NIO. However, the specific figures and their correlation with the company's stated break-even strategy are subjects of considerable interest. Analysts are keen to understand if the R&D spending is yielding expected returns and if the pace of innovation aligns with market demands and competitive pressures. The company's commitment to developing advanced technologies, including autonomous driving and next-generation battery systems, necessitates substantial R&D investment. But the efficiency and effectiveness of these expenditures are key metrics for evaluating long-term viability. NIO's break-even strategy is another focal point. Achieving profitability is a crucial milestone for any growing company, and the timeline and specific actions outlined by NIO to reach this goal are under the microscope. The report may offer insights into cost reduction measures, operational efficiencies, and revenue enhancement strategies that contribute to the break-even objective. However, any perceived misalignments between R&D spending, operational costs, and revenue growth could raise questions about the feasibility or timeline of achieving profitability. Pricing and vehicle margin targets also present a nuanced discussion. In a competitive market, pricing strategies are vital for capturing market share while ensuring profitability. NIO's approach to pricing its diverse range of electric vehicles, from mass-market models to premium offerings, directly impacts its revenue streams and gross margins. The report likely details the company's current vehicle margins and its targets for future improvement. Achieving higher margins often requires a combination of production efficiencies, premium product positioning, and effective cost management throughout the supply chain. Any targets that appear overly aggressive or unachievable given current market conditions could be a point of concern for investors. The contradictions that may emerge from the Q2 2025 report could stem from the balancing act NIO must perform, investing heavily in future technologies while simultaneously striving for profitability and market share. For instance, a high R&D spend might conflict with aggressive break-even targets if not managed effectively, or ambitious pricing might not translate into desired margins if market absorption is weak. Understanding these interdependencies is crucial for a comprehensive assessment of NIO's financial health and strategic direction. Ultimately, the Q2 2025 financial report serves as a critical update for stakeholders, offering a granular view of NIO's operational and financial strategies. The market will be closely watching how the company navigates these complex dynamics to achieve its long-term objectives. These detailed financial analyses provide a crucial perspective on the companies shaping the future of mobility. But what's the overall takeaway from this week's news cycle? That's a wrap on another packed episode of ElectroDrive News. We saw NIO stage a strong comeback in August sales, XPeng continue its impressive growth, and Li Auto navigate some challenges. We also looked at the market's reaction, with stock futures shifting, heard directly from NIO's earnings call about their growth and hurdles, and uncovered some key financial details from another major EV player. Don't miss out on any of the action. Make sure you're subscribed, hit that notification bell, like this video if you found it helpful, and drop a comment below with your thoughts on these updates. Follow us on all social platforms for even more insights. We'll catch you in the next one.